and welcome to our Gold Leaf Farming March 2024 webinar, where we're just going to share a little bit of an update on our firm and then the opportunities that we're seeing in farmland investing at the moment. So just as a quick overview of what we'll cover today, first you'll meet the team, then talk a little bit about Gold Leaf and what we've been up to the last few years and our plans for the future, look at the opportunity in almonds and pistachios that we see and the unique current moment that we're in, given the market environment today. Talk a little bit about our strategy and investments, and then we'll save plenty of time at the end for Q&A, which you can use the Q&A chat, which you should see at the bottom of your screen. So you won't see other folks' questions, but those will come to Josh, Brandon, and I. So without further delay, let's go ahead and get started, and I'll kick over to Brandon to introduce himself.
Hey, good morning, and thanks everyone for tuning in today. I'm Brandon Rebiero. I'm the co-founder and head of farming at Gold Leaf. All that really means is I'm the farmer in the partnership, trained agronomist. I'm on the Almond Board of California, and I really spend most of my time at Gold Leaf sort of leading the agronomy and the farming strategy. Prior to this, I helped develop and roll up a large almond portfolio with an exit. And then I went to Cal Poly San Luis Obispo, Harvard of the West, for any other Cal Poly alum out there. Josh?
Hey guys, yeah, Josh Guggenheim here. I lead acquisitions here at Gold Leaf. So everything around determining which areas we should target, how we should target them, which deals to buy, which deals we shouldn't buy, falls under me. I, before doing Gold Leaf, was doing private equity at a firm called Lightview Capital. Started my career at Deutsche Bank and went to college at Emory, which was actually one of the 5 Harvards of the South, Brandon. So we all went to Harvard here, I guess.
Awesome. And I'm Tanner Snider. I lead investment strategy and the operations of our investment business here at Gold Leaf. Started my career at McKinsey & Company, did a lot of ag and industrials work there, and studied finance and economics at Indiana. So that's the 3 of us. And you'll meet a little bit here, the rest of our team. Just wanted to flash up who else makes it possible here. Jack is Brandon's co-founder and CEO, who, similar to me, went to Indiana and started at McKinsey before being a private equity investor. The rest of our leadership team here at the top, which has, who have various experience across a number of ag, food, and agronomy businesses. So, a lot of talent all around. And then really the most important people in the business here, this full group at the bottom, which are our farm operators, our asset managers, farm managers, and the various support staff that help us make sure the farms are being run well every single day. So, we definitely couldn't do it without this full team of nearly 80 that we have here at Gold Leaf. So that's the team. Now, Brandon, would you share a little bit more about how Gold Leaf got started and then where we are today?
Sure, happy to do that. So we always have sort of joked it was 2 guys and 2 trucks, and all we mean by that is we were pretty scrappy in the early days, just working out of our houses, me mostly my truck. Jack's background were quite different. He is from Indiana, came out to go to business school at Stanford. His background's a McKinsey consultant and then a TPG investor, basically investing in food and ag. Hence the Subaru. And then I'm the farmer of the group, hence the white Ford truck. Basically, I came from small family farm. It was my grandfather's 30-acre orchard. Wasn't born into like this 10th generation farming empire. So I knew I loved farming, was very passionate about it, but just had to figure out how to make a living doing it. Went away to Cal Poly, studied agronomy and the plant sciences, came back and was basically like a licensed consultant agronomist. In California, we call it a PCA. Then started a farm management company. And then it was about that time where Jack and I were introduced by a mutual friend when I was doing that 10,000 acre development roll up. And our first deal was 130 acres in San Joaquin, California. And we're now around 12,000 acres. But anyways, I think the Genesis story works is because we have the complementary skill sets of a finance background and ag background. So here's sort of a glimpse of what our footprint looks like now. Broadly speaking, it's about 12,000 acres. There's 26 farms within this footprint, 80 folks on the team, and about 10 different water districts. A third of this portfolio is organic. And what I like about this, it's interesting, is you can see to the north, we're in Sacramento, to the south in Bakersfield. That really encompasses our almond pistachio footprint. So it's really a nice hedge on weather and also water districts. Beyond that, in the south, if you look near the Arizona-California border, that's Yuma. We have one date holding there. And then we have a pretty large pistachio holding in Kingman, Arizona, which you'll see off to the right. Sort of the beauty of this is we can operate them independently, separately, so they get a lot of focus, but we can really leverage that scale to obviously get better buying positions. We can also aggregate volume for better sales process. And then we do some value add where we can do organic. We do it because the premiums are good, but it doesn't make sense everywhere. It's very environmental specific. And we also leverage, ag tech to juice the yields and save cost. And lastly, our team's pretty deep. I think what's interesting here is we don't outsource any of the farming to a farm management company. We don't lease anything out to someone else and let them farm it. We have the in-house expertise to own and operate these orchards on the investment side and also the operational side.
Awesome. Thanks, Brandon. And so, now we're going to take a turn and talk really about, why are we so focused on almonds and pistachios? And to start that conversation, I actually want to do a little bit of almost a trivia question here, and ask if you can put in the chat or the Q&A box, what do you think that these three things might have in common? Advanced microchips, the really, really advanced ones, lithium, and almonds. Any ideas that you want to throw into the chat, please do, and give you just a second or two here to see if you've got any ideas. Anyone? All right. Growth, connections to the California economy, water, yep, they all do use water, of course. Future demand, yeah. I'd say all of these things are true. No one has hit it quite on the head yet. Supply demand imbalance, there we go. All need dirt. Yeah, I guess that's true as well. But I think supply demand imbalance is probably the closest. And so, what we really focus on is especially the supply concentration piece. So all of these three things are really concentrated in where the supply comes from. So as you can see, most of the world's microchips, in terms of the most advanced ones, are built in Taiwan, a little bit in South Korea. Lithium, really, really concentrated in a few countries. And similarly, almonds, almost 80% of the world's almonds on an annual basis are produced in the Central Valley of California. So not just the US, but really concentrated within California. And so, why does that matter? Well, really, it's because it does mean that there's a supply limitation. And so that supply demand imbalance really shows up. Now, what does that result mean? In microchips and lithium, we've seen some, really crazy extreme returns in the last few years from TSMC, the microchip manufacturer, and then various, lithium mining companies. This is one in Australia. Now, obviously, this is not a perfect comparison. There's differences among the sectors and things like that. But it really rings true still in almonds and pistachios. And almonds and pistachios have consistently outperformed in ag over the last 10 to 20 years. And this is primarily due to that supply demand profile that we were talking about. Ultimately, there are very few places in the world that you can, grow these crops. And the demand has been steady and growing, and so they've really outperformed the rest of ag. Now, what I'll mention real quick though is that as you can see, even other places in ag, whether it's permanent crops, commodity crops, or fresh produce, have not been a bad place to invest. In fact, many agriculture investors or folks that want ag exposure invest because if you just look at broadly U.S. farmland as a whole, the returns have actually been similar to the S&P 500 over the last 70 years, but with about half of the volatility. Farmland can also serve as an inflation hedge, which has been important in the last couple of years, and a number of other benefits of farmland investing. So really the asset class as a whole is a strong one, but has generally been pretty hard to get exposure to for private investors because it's all family owned, or maybe owned by a very large, institutional investor like a pension fund. And so that's one of the reasons why we're here in the market. So to dig a little bit deeper on the supply demand imbalance, as I mentioned, there's really only a few places in the world where you can grow the crops that we focus on. 80% of almonds, like I said, are in California, with some in Spain, Portugal, Australia, and Chile. Pistachio is slightly more distributed, but still over half in the Western US, and most of the rest of the supply in Turkey and Iran. And with Iran being a big producer, there's obviously also limited demand for that, given some of the sanctions and things like that. So it really is limited supply on both sides. And that's only getting tougher and tougher, whether it's rising temperatures that are putting downward pressure on pistachio yields because of the chill hours that they require, increasing rates of drought. There's also urbanization that's very significant in California. California is losing a lot of acreage to urban sprawl over the last 50 years. And then things like regulation, which are happening, not only in California, but also in places like Spain, Portugal, Chile, and Australia, mostly around water and climate, that make these crops even tougher to expand the growing regions as we go forward. And so there really is a significant supply constraint. On the demand side, though, there's been significant growth over the last 30 years, 4 to 5 times growth. And this is, more domestic consumption here in the US. But another huge opportunity, and something that we're seeing a lot of, is emerging markets with a growing middle class in places like China and India, who currently eat a lot fewer complex proteins like almonds and pistachios, are seeing an increased consumption as their incomes go up. And so, an interesting statistic here is that if China and India, which are both in the top 5 largest US export markets for almonds, were just to increase to 25% of the US per capita consumption, the total demand for almonds globally would increase by about 1 billion pounds, which is basically 30% of total supply. And given the supply constraint, there really, isn't that much supply growth possible. And so that's, a really important thing that we focus in on the terms of the long term of this type of investment. So anyways, maybe now over to Josh to talk a little bit about the current opportunity and price cycles in these crops.
Hey, great. Thanks a lot, Tanner. So this is similar to, maybe other commodities. I don't know if we've got folks on the call today who've invested in other ag. Maybe some people are in cacao right now. That's obviously pretty hot right now, but it's similar to other ag commodities, and it's also similar to other commodities like energy, where price is a bit cyclical. And when price is high, generally what happens is the growers or the producers are making really good margins. They reinvest a lot of the cash flow that they generate into creating new supply. When that supply comes online, the supply can grow faster than demand and prices come down. Then, when prices are low, people don't invest cash flow into new developments or to new, production. Demand is still growing, and you get a situation where demand is growing faster than supply, and prices will go up. So that's how it works in almonds. 4 or 5, I guess it's more than 4 or 5 years ago now, really 6, 7+ years ago, you had a high point in almonds. This was driven primarily, well, it's by a few things, but one of the big drivers here was that in 2014, the state introduced a lot of new water regulation, and there were really dry conditions. So because of that, people were worried about supply and almonds not having enough, water essentially in certain areas. Supply didn't grow, but demand did, and price reached an all-time high. Growers said, wow, this is great. Let's reinvest a bunch of our proceeds into building new almond orchards. They did that. When you plant an almond tree, it takes 6 years to come fully online. So what you see is if you planted in 2015, by 2021, all those almonds came online and that pressured price down. So right now we're in an area or a period of low almond price. It's a little tough for us, right? Because our margins are pretty low, right? They're lower than they are when prices average. But it's also a great opportunity to buy because when almond prices are low, just like other commodities, people want to sell their really good assets. They lose confidence in the space, and that's the time when smart investors can come in and buy great assets for great prices. When commodity price is high, you can't buy good assets. When commodity price is low, that's really the time to kind of double down and invest. So that's where we are today. It's an interesting time in the market. We get a lot of opportunity. We see a lot of deals. We've seen something like 1,200 different almond and pistachio deals in the last 6 years. And a lot of folks ask us, okay, who are your competitors? And to be honest, there aren't that many competitors doing exactly what we're doing. My background is more in, kind of lower middle market private equity. That was really competitive. Every time we saw a good deal, there were 10, 20 other buyers looking to buy. When we're buying in Goldleaf, we rarely are competing against another firm or another buyer. And the reason is just because of how the market is structured. So if you think about people we compete with, there's large family farmers. These are folks that have a majority of their assets in tree nuts. When price is low, they don't have excess capital to buy new deals. So that's number one. So right now, when price is low, these folks aren't buying, whereas we can. On the other hand, you've got institutional investors like Manulife or Canadian Pensions or whatnot. Those folks don't really want to do any deals that are lower than maybe like $40 or $50 million. We buy a lot of farms that are basically 10 to 15 million, which are too big for small farmers, but too small for institutions. So long story short, we're seeing a lot of great assets right now. And when we find a good asset, we're generally the only one in the process. The large family buyers don't have the cash to buy, and the institutions, frankly, aren't interested in what they see as, subscale checks. That is, the interesting macro level. It's obviously hard, a little bit easier said than done. And with that being said, Brandon, I'll let you tell the folks how we do what we do here and what makes our strategy a little different.
Yeah, so we're positioned well to acquire, but to get into a little more details of how we go about the strategy. So first of all, you just got to buy right. We're not trying to put lipstick on a pig or reinvent the wheel here. You can't buy a really flawed asset, a flawed orchard, and expect to turn it around if you got it at a discount, for instance. So my team, we spent a lot of time in the orchards during the diligence phase, from soil sampling to tissue sampling to all sorts of observational reporting. And then we dig in on some of the other important details like water. I will point out, we've looked at about 1,100 deals, and looked at doesn't mean just a quick kill. Like, we really look at them, and we've closed on 27. So our bar is quite high on what we consider to be a good orchard. I'd say most of the diligence dollars are spent on water, not just legal spend, but also we have a really good hydrologist and geologist firm that we use to really vet the details and the science behind the water, and what that longevity and runway will look like over the next 10 to 20 to 30 years, not just a current snapshot. We want to make sure there's a structural climate advantage with winters getting warmer. In California, we need to make sure we're in the right spots for the long haul. And then to be, the lowest cost producer, like any other commodity business, that's how you withstand the test of time. And lowest cost of production is all about yield. It doesn't move the needle that much if you're trying to cost cut. High yields drive the lowest cost of production, so this is where we want to be. Once we have the good asset in hand, we feel good about it, then we operate it using a few different tools. In general, our playbook that we call our best practices is really data driven. It's backed by a lot of research and in-house experiments that we continue to conduct. Ag tech, for some of you who may be experienced in the space, it's quite crowded. It's taken us some time to sort of vet what's nice to have, what's sexy versus like what's really driving value. I think we're in a good spot. We have a few tools we use that we focus on, and we have a long-standing track record with these tools. They need to either add yield or reduce cost. And then, once we are established there, we leverage our scale. We have a lot of acres, so we can get oftentimes better rates with some of these vendors, and in particular in ag tech, chem, and procurement. And then lastly, the sustainability mindset. I think this is a unique industry in that there aren't, economic trade-offs for pursuing things like organic or sustainably certified or bee friendly. It's actually the opposite. When we do these things, it's better for the business because there's oftentimes a premium associated with that. And I spoke to this a moment ago, but in terms of like our data-driven approach to acquiring some of these properties, we've built this in-house tool. It's basically an overlay of the Central Valley, and we can click in these different metrics. The most important being the water district, climate, and yield. So to speak to the water, we have all these water districts mapped out through different resources like our hydrology firms, our legal firms, and then we give them a ranking of where we want to be, and these get updated about twice a year. Then we overlay that with the climate, where the chill hours in orchard farming, in particular pistachios and almonds, there's a chill requirement. And all that means is we need the winters to be very cool so the trees can have a restful state. If the winters are warm in certain areas, the yields will suffer the next year. So we want to make sure we're investing in buying orchards that have good long-term winter chill hours. And then lastly, we overlay this with yield. We have a good sense of where the yields are within the valley, not just like regionally, but very site specific within each township and range. So we want to make sure, there's good yield history. History is often the best predictor of future performance. So where we have good track record for yield, that's where we want to be to make sure that our cost of production can be low. So to dig in a bit more on the ag tech and how we improve our efficiencies, I'd say one space gets me excited right now. That's really autonomous equipment. For the past 4 years, we've sort of been testing several of these vendors, and the lead horse has moved back and forth quite a few times. And that's what we like to do, is test before we fully commit to one. And I think what's interesting is the automation space sort of started off as you had this dedicated tractor that was only used for one thing, and it was very specialized. Now what we like and what we're seeing is they're basically taking the brains out of the Tesla and putting it on the John Deere, if you will. And that allows us to get better utility out of the existing fleet we have without this huge CapEx event. It also is going to allow us to be more labor efficient over time, reduce our headcount per acre. I'd say in general, we're probably 1 employee per 200 acres, 150 to 200. We think over time we can get that to 1 per 300, 1 per 400. And then moving down below, all of our orchards are micro irrigation. That's the most efficient form of water savings and water utilization by the tree. Then there's 3 legs to the stool in the ag tech. We use Hortal to actually measure the heartbeat of what the roots are asking for in terms of water, so that the water we deliver is very data driven. We're only applying the amount of water the tree is asking for, and we can measure that in real time. Then we use another tool called Semios. That's more of like our macro ET, which is how much water are we forecasting the plants will need. And then lastly, we do remote sensing via series imaging. Think of this as like a Doppler radar. This is really like a report card of all these actions we're taking. How are we doing? Are there areas of red that we need to go investigate to do some site-specific management? And then lastly, some of our sustainability initiatives. We're doing solar where it makes sense. Solar doesn't make sense everywhere, but we spend a lot of time in the ROI modeling to make sure we can do solar where it makes the most sense. And then just as last year, we did a pretty exciting water banking project that we're going to continue to do into the future.
Awesome. Thanks, Brandon. And then to dive a little bit further, into how we think about sustainability and sustainable farming, it's really about, making sure that we're investing in our team, because everything ultimately starts with the people that we have on our farms operating every day. We've got to have the best people so that we can do some of these hard things like using ag tech, converting to organic, all things that are more challenging than just traditional conventional farming. And together, we believe that that's going to drive stronger returns and results in the long run, whether that's, for our team or agronomically, as well as financially. So a few examples here of the things that we do, which are pretty unique. One is we pay living wage to our farm operators in California, so all of our hourly folks. They also have fully paid healthcare, and I think the story there is pretty interesting. Back in 2019, a couple of years after the firm was founded by Brandon and Jack, they took a minute to write down sort of the values of the firm and the vision and those sorts of things. And then a few months later, COVID hit, right? And we were expecting all of our farm operators to continue showing up to work every day. And I think there was basically a little bit of a kind of an aha moment where it was like, well, if we've got COVID going on and we need to, and we expect our workers to be there, they should feel safe doing so and have healthcare. So we're one of the very few players in ag that provides healthcare to our team and grants equity ownership in the farms to everyone, so that incentives are well aligned with our investors and the owners of the firm. On our farms, we're transitioning a significant chunk of our acreage to organic. Like Brandon said, that has historically driven a 70+% price premium after the 3-year transition. So it not only is better for the environment with no chemical usage, but drives a stronger result. Things like regenerative farming practices and soil health and water holding capacity that we do. And making sure that ultimately we just have better results. And so that's the premium, but that's also things like having 3 times the average of ag industry average retention for our farming team, and then beating average yields in the state of California on our conventional orchards by 26% last year. So a lot of things that that we believe are going to just drive better long-term results, because ultimately, if we're not taking care of the people and the planet, we're not going to be very good farmers for very long. We rely on natural resources, soil, water, etc., and our team to have good long-term results. So, now talking a little bit just about the opportunity and kind of the financial side of the business and the investment opportunity, I'll kick it over to Josh to highlight the opportunity that we see now.
Yep. So the big question, how do investors make money? There are really three components that drive returns here. The first one is annual crop cash flows. So, other farmland investment firms, they might buy a farm and then lease it out to a third party, and they make money by collecting the lease payments. We don't do that. We farm the crop ourselves with our own team, and then we sell the crop at the end of the year. So, right now we're just finishing pollination and starting the season. By September, we'll harvest. We sell the crop to a processor, and then basically all those proceeds we get from the processor, we distribute out as cash to our investors. It will depend on commodity price. There's high years and low years, but generally we're targeting, low teens distribution, which we collect, it's one crop per year, but we distribute quarterly. That's a large part of the returns. The second is appreciation. So we are generally buying the land. California farmland and actually national farmland has appreciated something like 5, 6, 7% on average per year. So we do think that these assets that we buy, the underlying land, will appreciate. There are opportunities for a lot of upside too. So like things like if a farm gets converted into housing or into industrial or into something else, there's opportunity for a lot of appreciation, actually. We don't underwrite to that, but that is an opportunity too that we're kind of excited about. We actually just bought a pretty exciting farm right on the outskirts of Bakersfield, which I bet will go to housing. But long story short, that's not what we're underwriting in our model. The last piece is tax. Farmland, in particular, farmland with improvements is pretty effective and efficient from a tax perspective. When we buy a farm, about half of the value comes in the form of improvements. So trees, wells, irrigation, etc. All of those improvements qualify for bonus depreciation. So when we buy a new asset, we end up generating a pretty nice passive loss that's passed on to investors through the K1. And investors can either use that loss to offset other passive income or offset future income from this opportunity. So it's a pretty good tax play too. So long story short, we're targeting kind of mid-teens net IRR tax adjusted. Most of that driven by annual cash flows, appreciation at exit, and then the tax component too.
Awesome. And Josh, can you just tie this back and kind of the current investment opportunity that we see to the moment that we're at in the almond pricing cycle, and why now is a particularly interesting time to be looking at this space?
Yeah, good question. Thanks, Tanner. So yeah, basically what we mentioned is we're at a low price point in almonds right now. So people are basically selling good farms for a really cheap price. And the deals that we're seeing on the market, if you underwrite them, are really in the higher end of this range. We see some deals that are really like they can underwrite to 20, 22, 24% net IRR. When you're in a different part of the cycle and everything's going really, really well, the prices of the farms go up. So you're underwriting, you can't basically underwrite to the same level of returns. And if you actually look back historically and you look how have almond investors done based on different time points, you'd see that if you actually bought almond farms in 2002, which was a really a low point in the cycle, those folks averaged something like 20% IRR on their investments. If they had waited until the cycle normalized and bought in, let's say, 2008, kind of average price, those folks did something like a 15% IRR. So, there is a difference in that 5% in IRR. It doesn't sound like much, but compounded over 15, 20-year hold, it's really substantial. So you're talking about like a multiple of your money, like a 10x if you had bought in 2003 versus just a 4x in 2008, which is fine. But, long story short, this is the same as investing in real estate or commodities. The entry price is really important, and we're excited about today's moment in the market because we see awesome entry prices, which allows us to underwrite to better returns.
Awesome. Thanks, Josh. So we're gonna basically wrap up here with with kind of the first high level overview. We do have various opportunities to invest in this moment, and we'd love to to share more on that, but don't want to go into too many specifics or details given we have a various group or categories in the audience. So if you're interested in learning more, please get in touch with us. You're going to get this information in a follow-up that you'll receive tomorrow from Zoom, but you can reach us at investors@goldleaf.ag or visit our website at www.goldleaf.ag if you're interested in learning more and think about investing in farmland. So with that, now I think we're gonna go over and take some questions. So I'll be taking a look in this Q&A chat, and really the first question that I'm seeing here is, why is the price at an all-time low when demand is so high, and why isn't that high demand driving up price? And so let's see, I think we can take a look here at what's going on. And it's really more of a supply side story. So if you look back at the pricing cycle, let me just get back to this page. So in this period here, there was a significant amount of plantings, as Josh said. So you can see in this 2014 to 16 range, there was a lot of planting. All of that supply ended up coming online, 4 to 6 years later, which is how long it takes for an almond tree to ramp up to production. So in 2020, between 2018 and 2020, there was a 37% increase in US supply of almonds. And reminder that, California or US supply is about 80% of global supply. So there was a massive, positive supply shock that caused price to go down. And while demand is still growing, basically there was one very big crop that increased, increased supply and carryover. Now that price is lower, we're seeing the opposite thing happen. So, since prices dropped, you've seen less and less new plantings, and the supply has actually come down. So we've seen supply in terms of the total pounds per crop go from a 3.1 billion pound crop in 2020 to about a 2.4 to 2.5 billion pound crop the last 2 years. So that's been, the imbalance is that there was the huge increase, even though demand is steadily, still growing. There was that big supply shock. So it's really more of a short-term thing in terms of the supply imbalance that's causing this. Hopefully that answered the question. We have a little question here on what is the break-even price point? So Josh, maybe I'll throw that over to you.
Yeah, sure. So it really depends, which farm you're buying. So for the average farmer in California, right? It actually, thanks very much for showing this. This actually is better than what my answer would have been. You can look here and see the cost curves. So basically what this shows is the percentile of growers which produce at various cost points. So if you look, for example, at the levered cost, so that's with debt, and you look at $2, only 10% of growers produce at that point, basically, or better, meaning 90% of growers lose money when price is $2 after debt. So long story short, like at current pricing, let's say $1.75, $2, most growers are making a little bit of money before, or I guess most growers might, 50% of growers or so are breaking even before debt, but after debt, it's something like 90% of growers are actually losing money. And that's why right now such a good buy period, actually, because price is so low, some people are losing monies on their farm, and they're looking to sell for whatever price. Generally for us, we target the highest yield areas, and those yields are basically pounds per acre. So if you can buy really good farms with really good pounds per acre, you're going to be in the good side of this cost curve. If you buy farms with bad yield, no matter what you do operationally, you're going to lose money at low prices. So what we try to do at Gold Leaf is basically buy farms that can break even when price is really low, and then make really good margins when price is high. We don't want to buy lower quality farms that basically can't make money when price is low. We at least want to pay the bills, if you will. So good question.
Great. And then can one of you maybe just weigh in here on what is the current pricing of farms per acre versus, maybe the 10 or 20-year averages, or even what we were seeing, just a few years ago?
Yeah, sure. So, basically, this is actually good chart. Thanks, Tanner. Showing like the cap rates, what, at average price, the farms we can buy. Historically, we were buying something at like, 8 to 11% cap rates. The last couple of deals we bought have been kind of 14% plus, which is nice. But I guess the question was in regards to, per acre pricing. It depends. I would say the average decent almond might have been 35,000 an acre, 38,000 an acre a few years ago, especially with low rates. Now it may be 28 to 30, something like that. So there is a significant decrease, maybe 32, 34, something like that. So prices have come off, let's just say 10, 20%, depending on the area. It's not like it's a 50% discount. But maybe 10 to 25% on average, something like that.
And like you said, the security of the water rights and various things also impact that. And at Gold Leaf, we would never be even looking at any sort of farm that didn't have really strong long-term water security and the right climate positioning, because you just can't farm well if you don't have those things. Brandon, maybe one for you here. We got a question around, what's the difference between, quality and production and stuff in California versus Kingman. I think we may have not been clear that that's a pistachio farm, so we actually don't farm almonds in Kingman, but it's pistachios. And do we plan to expand farming in the Kingman area? So can you maybe talk a little bit about that, Brandon?
Yeah, so to be clear, Tanner's right. Almonds are very, very climatic specific. So that's the reason 80% of the supply globally is in California, is because we have that perfect Mediterranean climate. If you just go one state over into Arizona, it's not ideal. For instance, we just take on too much frost risk in Arizona. But basically, it's a pistachio play in Arizona. We'd love to continue expanding in Kingman, Arizona, but we're just going to let the opportunities dictate growth versus this mandate of forced growth. So if the right opportunity comes up, we'll expand out there. But the Kingman pistachio play we're very pleased with it. We had our first harvest last year, on par with California. Kingman is about the same latitude as Bakersfield, which Bakersfield, for those of you who don't know, is one of the largest pistachio producing areas in the world, within Kern County. Same latitude, about 5 degrees warmer than Bakersfield in the summer, which is a good thing, and about 10 degrees cooler in the winter, which gives us more chill. So we're very optimistic about Kingman from a pistachio perspective, and we expect quality to be very similar.
Great. We're getting a lot of questions here, so thanks everyone. I don't know that we'll be able to get to all of them. So again, if you would like to have further conversation, please reach out to us. And I'll bounce back to that page while I'm going to the next question, so that you can reach out. A few quick ones that I can hit here. Do we allow our IRA investment? The answer to that is yes. You can get in touch with us on more details there. Do opportunity zones impact your decision on farm location? The answer to that is sometimes. So we have done a separate partnership or investment vehicle for opportunity zone farms in the past, and we have five of those. We may look at at opening up another opportunity zone fund in the future, but that's less of a focus at the moment. Let's see here, other questions. So a question asked here on kind of the next, call it 5 to 8 years of almond pricing, and where we expect pricing to go over that time frame. And like, do we feel like we can hit another upcycle like we've seen in the past, or is this ultimately just kind of commodity price risk or speculation? So we'll talk a little bit about that, and I'm going to go back to this page here. I think that typically what happens, and we've got to go back to what's happening in the broader market, which is when prices are very, very low, as Josh said, maybe 90% of almond growers right now or more are losing money. So there's very limited liquidity in the market, quite a bit of distress, especially among the smaller growers. And there just isn't much reinvestment in replanting almonds. And so the thing that we see play out is in these time periods, we actually see acreage getting ripped out and abandoned because it's too expensive to farm it or continue farming it, and they'd rather turn it into maybe rent it out for tomato farming or something else that's that's more profitable in the moment, especially if it's a farm with worse water security, more expensive farming operation, essentially. So we're seeing net abandonments and rip outs well above replantings right now, while demand has been steadily growing. So the last 2 years, shipments out of the US have been around 2.6 to 2.8 billion pounds over the last 3 to 4 years. The last 2 years have been about 2.4 to 2.5 billion pound crops. And so as acreage is coming out, it's getting increasingly more challenging to hit those high crop years. You have to have basically a perfect weather year to hit a 3 billion pound crop again, because there's just less acreage on which to do it. So of course, investing in farming and farmland, there is commodity exposure and price exposure there. And we like to work with investors who think about this on a through cycle mindset. But we really do think that because of what's happening with the rip outs and abandonments, it's very likely that we'll see something just like the last pricing cycles. And so when we underwrite our investments, typically we look at a few scenarios. One scenario is getting back to the inflation adjusted average price that we've looked at for the last 30 years, which is around $3. So that's typically our base case. But then we also look at a case which is indexed to the last 2 upcycles, which would obviously mean a significant ramp up in price over the next 5 to 8 years, followed by a decline. So, obviously there is, of course, we don't know what's going to happen. If we knew exactly what commodity prices would be, we probably wouldn't have to continue working anymore. But we feel really good about what's setting up in terms of the opportunity over the next 5 to 7 years in the market. Brandon, maybe one for you. What percentage of the almond market does GLF control in the Central Valley, or kind of total US almond production?
Hard number to peg sort of offhand, but I do know that we're in the top 25 largest growers in California and probably the world. There's about 7,000 almond growers in California. And we're top 25. Of those 7,000, roughly, about 70% are owned by growers who have less than 100 acres. So it's an extremely fragmented industry, which makes sort of the acquisition front really exciting because it's not super accessible in terms of trying to piece together a bunch of stuff. But those smaller acres tends to be our sweet spot. We tend to stake a flag and then aggregate other orchards and do the hub and spoke model. But being in the top 25 growers, back to the question, certainly helps us in terms of negotiating our processor offtake agreements, as well as our input spend.
Great. And then a few questions here that might be good for Josh. One is the current investment opportunity only in new deals, or is it, more of a vehicle that has existing deals plus new ones that we'll be buying? And then are we using debt to buy farms when we do?
Yeah, good question. So the investment would be into an entity called Gold Leaf Farming LP. The entity currently owns 16 farms, and as we raise more capital, we will be buying more farms in that entity. So if you were to write a check, you get exposed, you get basically shares in this entity and exposure to 16 farms that we already own. And then as we raise more capital into that entity and buy more farms, you get exposure to those too. So good question. You'd be, fully invested day one and get exposure. This is not some close-ended fund where we raise capital and then we'll buy future farms. It's different. So good question on that. And then debt. Yes, we do use debt. We generally use 30 to, let's say, 50% LTV on our properties. So we do use moderate debt, but less than what you might see in other real estate transactions. The debt is generally very long amort, like 20, 25-year amort, which aligns with the life of the orchard. And we generally fix rates when we can.
Great. Thanks, Josh. And then what types of crop insurance do we use? And maybe talk a little bit about the crop insurance system to protect revenue and yield.
Yeah, sure. So crop insurance is fantastic. It's a great tool actually for the American farmer, and I'm happy about it that the government subsidizes it. So basically what crop insurance does is it allows you to insure a baseline level of yield if something happens, like a weird weather event, which weird weather events do happen, maybe 1 in every 10 or 20 years. But the nice thing is that you can be insured a certain level of yield. So for example, if an orchard does 1,000 pounds of yield on average, you can buy insurance up to 80% of that. So 800 pounds per acre. So if you ever have a weird weather event and you have 0 pounds per acre, the insurance will pay you as if you had produced 800 pounds per acre in that example. So what we generally do is we insure to 75 to 80% yield across all of our farms. And that really creates pretty good downside protection if a weird weather event happens, like if there's a frost one year or something else. So good question. Crop insurance, as I mentioned, is also subsidized by the federal government, and it ends up costing something like $100 to $200 per acre. Our total cost structure might be about $3,500 or $4,000 per acre. So it's a relatively small amount of our total cost structure and is pretty cheap relatively, but can create like a really meaningful downside protection and really hedges the risk of weather in this for our strategy.
Great, thanks. We've got a question, which I think I can take, going back to kind of the percentage of acreage in California that is owned by investment funds or asset managers similar to us. And I was thinking about Brandon's answer. There's about 1.5 million acres of almonds in California, and only about 6,000 acres are ours in terms of almonds. So that's like well under 1%. I think it's under 0.5% that we own. So we're still, even though we're one of the top 20 players in the space, it's still a very fragmented market and industry. And so we're, a big player, but they're, still very, very small in terms of the grand scheme of acreage. And then in terms of the percent of acreage that, is owned by larger groups like ours, actually a lot of the larger groups are actually those large family farmers, and I don't think you would consider them, in this bucket. But I would say, I don't know, what do you think, Josh or Brandon? It's probably still less than 5% of total acreage that's owned by sort of an institutional level player. Would you agree?
Yeah, it's pretty fragmented. Maybe the biggest one is like 3 or 4%, something like that, of the market. So almonds are very fragmented. Pistachios are a little bit more concentrated, where the biggest player, Wonderful, might own something like 20% of all acreage in the state. Almonds being more fragmented.
Great. We're getting close here on time, so probably just have time for one or two more, and we have a lot of questions still coming in. One question here is, would we actually be able to talk a little bit about the, supply demand dynamics for organic versus non-organic, and how that might look over time and how that factors into our kind of portfolio construction? I can take a stab at this one, and then Josh or Brandon, feel free to jump in. So in recent history, organic almonds have been, which is the primary part of our organic strategy, is in almonds, not pistachios. Organic supply has been between 1 and 1.5% of total US almond supply. So it's a very, very small market. In the grand scheme of commodities, almonds are quite small. So they're not traded on an exchange. You can't trade almond futures, things like that. And so almonds, as a whole, are relatively small commodity. Maybe 3 to 4 billion pounds per year globally. Organic is much, much smaller than that. Maybe 20 to 30 million pounds in the US in terms of supply. And so what that means is the market is just a lot less liquid, and it's a little bit harder to get really, really good data on what's happening and playing out on a quarterly or monthly basis in organic. I think that how we think about it is, the health and a lot of the trends around food and chemical use continue to be, very, very strong. I think when you have moments around inflation or higher pricing, of course, you see some people switch away to cheaper alternatives. And so that, can suppress organic. But I think in the long run, we feel very good about, where organic is heading. And there's a very big barrier to entry on the supply side, because it takes 3 years. A lot of farmers don't have the skill set or playbook to do so. And so, it feels like a relatively safe investment. And even if the price premium does compress some, it's still a move worth making, financially, and and from an angle of taking care of people and planet. Brandon or Josh, anything to add there to wrap us up?
I think you covered it pretty well.
Awesome. Well, we are at time here, so we'll go ahead and finish up here. I think this page has been here for a while now, so please don't hesitate to reach out to us if you want to learn more. We would love to have you talk with one or two of us on the team individually and see if, farmland investing, or specifically investing in, in one of our opportunities, might be the right fit for you. So don't hesitate to reach out. Thank you so much for joining today, and you will receive a follow-up email, with this information to be able to reach out, or schedule time directly. So thanks, everyone. Have a good Friday and a good weekend, and we hope to hear from you soon.
Thank you.